Warren Buffett and Charlie Munger. You know them. They're the undisputed titans of value investing. And then you've got Amazon, the undisputed titan of, well, just about everything else. For years, these two worlds felt like they were galaxies apart. But what if we took the legendary duo's super strict investing checklist and actually applied it to Amazon, right here, right now? You know what? Let's do it. Everything you need to know is right here in this one quote. Seriously, this is the whole game plan. And it gives us two big questions for this entire explainer. First, is Amazon actually a wonderful company by their standards? And second, maybe even more important, is it selling at a fair price? We're going to tackle both using the very same playbook that built the entire Berkshire Hathaway empire. So yeah, that's the big challenge for us today. We are going to put Amazon through the ringer. We're going to systematically check out its business quality, we'll dig into its financial strength, and then we'll get to that all-important final boss, the price tag. Let's get right into it. All right, first things first, the quality of the business itself. And I mean, for just a minute, let's totally forget about the stock price. Buffett and Munger always start here. They ask, is this a business we'd want to own lock, stock, and barrel for the next 20, 30, maybe even 50 years? And to figure that out, they don't just go with their gut. Nope, they use a very clear, very disciplined checklist. And we're going to use these exact same questions as our guide. Think of this as our roadmap for taking Amazon apart, piece by piece, from its competitive advantages all the way down to the people running the show. The absolute heart of a great business is what Buffett famously calls a durable competitive advantage, or an economic moat. You got to think of it like a castle. The business is the castle, and the profits are the treasure inside. The real question is, how deep and how wide is the moat protecting that castle from all the invaders trying to get in? The stronger the moat, the safer those profits are for years and years to come. And these moats, they come in a few key flavors. You've got a powerful brand that people just trust, no questions asked, a massive cost advantage that lets you sell cheaper than anyone else. You've got network effects where the service gets better and better the more people use it. And finally, high switching costs, where it's just a huge pain for your customers to leave. So, does Amazon have any of these? Let's find out. Okay, this is Amazon in their own words, and it's so telling because it speaks directly to their brand moat. That relentless customer obsession is the engine behind it all. For millions of us, Prime isn't just some service, it's the default way to shop. It's built on decades of trust that your package will show up fast every single time. That's a powerful brand. And boom, this quote right here, this perfectly illustrates their other massive moats. Amazon Web Services, their real profit machine, is a textbook case of network effects. See, the more companies build their stuff on AWS, the more cool tools become available, which then attracts even more companies. It's a powerful cycle, and it creates insanely high switching costs. Can you imagine trying to move your entire company's digital backbone off of AWS? It's a gigantic, expensive, and super risky job. And finally, let's talk about management quality, which is not on our checklist. This quote from Jeff Bezos, it's pure Buffett and Munger. It's like he's speaking their language. They demand managers who are rational, who think like owners, and who absolutely refuse to get complacent. And Amazon's whole culture of constant invention, from AWS to Kuiper satellites, it just screams that they have this deep-seated drive to be different and to think in decades, not just financial quarters. So look, the story is amazing, it's super compelling, but a great story has to be backed up by great numbers. That brings us to financial strength and profitability. Buffett and Munger are famously skeptical guys. They demand a balance sheet that is rock solid. So let's ask the question, is Amazon a financial fortress, or is it a house of cards? First test on the chopping block, debt. Buffett absolutely hates it when companies take on too much debt because it makes them fragile. So his rule of thumb is a debt-to-equity ratio of less than 0.5. Simple as that. So how does Amazon measure up? And there's our answer. At about 0.25, Amazon's ratio is literally half the maximum level they'd ever tolerate. So it passes this test with flying colors. This shows a really conservative, really prudent financial structure, which is exactly the kind of thing value investors get excited about. Okay, next up, profitability. Look, it's not enough just to be big. A truly wonderful company has to be super efficient at turning the money shareholders give it into actual profit. The big benchmark here is return on equity, or ROE. The goal is to see a number that's consistently over 15%, because that proves the company is an elite machine for compounding capital. And another decisive pass, over 24%. I mean, that's not just passing, that's acing the test. This level of profitability just goes to show you how powerful their business model is and how dialed in their operations really are. Let's just take a breath and recap what we're seeing here. Low debt? Check. Big pass. The ability to pay the interest on its debt 34 times over? That's an overwhelming pass. High return on equity? A resounding pass. From a financial strength and profitability perspective, Amazon absolutely looks like a fortress. Now, let's talk about the quality of those earnings. This chart is so important. It shows the steady, consistent, even accelerating growth of AWS, which is Amazon's main profit driver. This isn't some quirky one-time income boost. This is steady, predictable growth from a dominant force in cloud computing, a business with massive tailwinds for years to come. This is the exact kind of resilient earnings power Buffett and Munger are looking for. So we've established that Amazon has this huge moat, and its financials are like a fortress. But this brings up another huge question. What does management do with all that cash it's generating? And that leads us right into where we have to look at how they allocate that capital, and of course, the final most critical question of all, valuation. Now, before we see how Amazon spends its money, we need to understand the golden rule. This is the absolute core of value investing. It's called the margin of safety. It just means you do the homework to figure out what a business is really truly worth, its intrinsic value. And then, you only pull the trigger when the market is offering it to you at a big discount. That discount is your safety net. It's your protection against being wrong. One of the best ways to get a clue about a company's real value is to watch how its managers spend the money. And as you can see here, Amazon is famous for its super aggressive reinvestment strategy. Instead of paying out big dividends to shareholders, it plows billions right back into growing AWS and logistics, making these huge, bold bets like Project Cooper and buying other companies. For a value investor, the question isn't whether this is good or bad, it's, are these investments actually generating high returns? Okay, we've looked at the company through the lens of its business quality, we've stress-tested its financials, and we've examined how it spends its cash. Now, it's time to bring it all together. It's time for the verdict. So here's where the rubber meets the road. On one side, you have an undeniably dominant economic moat, incredible financial health, visionary management, and consistent earnings. It checks almost every single box for being a wonderful company. But on the other side, it faces ferocious competition, it's got regulatory risks breathing down its neck, and its focus on reinvestment leads us to the ultimate final question for any value investor. When you look at today's valuation, is there a margin of safety? Is there really a discount? And this is where Charlie Munger's wisdom just hits you. This philosophy isn't about jumping in and out of stocks. It's about finding one of these exceptional businesses and then having the patience to just sit on it for years, maybe even decades, and let the value compound. So the decision isn't just about today's price, it's about what you believe this company's earning power is going to be 10 or 20 years from now. And that, right there, is the billion, well, in this case, the trillion-dollar question. Our analysis shows pretty clearly that Amazon passes the wonderful company tests with flying colors. But whether it's being offered at a fair price with a big enough margin of safety, well, that's the final judgment call every single investor has to make for themselves. And that right there, that's the art and the discipline of the Buffett-Munger approach.